Wait a second. So there's no RMD on a Roth?
Yeah. That's the aha moment.
There's no required minimum distribution on a Roth.
Yeah.
I did not know that. So let's talk about real quick 401k, because we get a lot of emails about 401k. Your 401k balance may have gone up over the last few years, but one economist says it may actually have lost money. How is that possible? In a new report shared with Fox Business, he says inflation and bonds are to blame.
Yeah.
What say you?
Yeah, I mean, so most 60-year-olds are mixing bonds. This economist E.J. Antoni talked about that it grew by $11,000, and when adjusted for inflation, it represents a 9.2% loss. Well, that's not including taxes. Also, by the way,
right?
That's just pre-tax. That's gross. So when you include taxes in there on top of that, I mean, yeah, did you actually make any money?
You talk about that all the time. Is it even still worth, again, and like with me, I get a company match. Is it still worth investing in your traditional 401k?
Well, typically, the answer is if you have the Roth option, you should. It depends on the situation, but most of the time we're recommending the 401k Roth if your employer allows it. Because it's after tax, and then you're getting the match from the employer, right? You're getting,
but like I don't have that available. I don't think. I've asked. I don't think I've got it available.
I think we checked with yours.
You've got my stuff.
Yeah, we checked. I don't think yours does, but most employers are headed that way. If not, you got to bug the HR person about it until they do, because it's ridiculous that it doesn't cost them any extra. It's just a tax allocation. It doesn't matter if it's going pre-tax, after-tax, Roth. It's just another accounting method. So, but here's why that it's good to go in a Roth 401k versus a pre-tax, because you pay the tax on the seed and not the harvest. And so at 73, when you start to take out the money, maybe you don't need it all. Maybe you've done well outside of your retirement plan, like we're coaching people. Don't just put in your 401k. Invest into after-tax things like real estate or a business or investing into the stock market or whatever. There's a lot of different ways to generate wealth besides saving in your 401k. So if you're 73 and you got $3 million in your 401k, I mean, currently you're going to have to take, goodness gracious, I'm doing the math in my head, so forgive me if I'm off, $108,000 that you're going to have to take. And if it's all pre-tax and you're in a high tax bracket, you might pay $30,000, $40,000 a year. So what if you don't need it? You're just going to give $30,000 over to the government because you're forced to take it out. If there was $3 million on a Roth, you don't take anything.
Wait a second. So there's no RMD on a Roth?
Yeah. That's the aha moment.
There's no required minimum distribution on a Roth. Yeah. I did not know that. Yeah. But also, isn't there a cap? I mean, if you're HCE, you can't do Roth, right?
No, it has nothing to do with it. So, there's two different kinds of Roths. Okay. And people get all confused. I'm going to keep it real simple. They got the individual Roth IRA, right? Like the one that you own and control, and you set up an account at the bank or the brokerage house. So we manage a lot of our money is at Fidelity Investments. So if our client's like, yeah, I'm thinking about doing a Roth, and I go, okay, well, let's look at your tax return. Well, last year you made $350,000. You're married, filing jointly. You don't qualify. Okay. So what's the other option? Well, you can do a backdoor Roth. That's a whole nother, that's a different.
Let's get into the weeds.
Yeah, we'll get in the weeds later on that. And that's if you don't have any other IRAs, you could do a backdoor Roth, because technically it's an after-tax IRA with a Roth conversion, and that's confusing. But the 401k Roth doesn't matter if you're a highly compensated employee. I am obviously the president of my company. I'm the highly compensated employee, and I am putting into it's twice a month, but into my 401k Roth, the maximum amount, and the company's matching. The match comes back pre-tax, which is fine. It's free money from the company, and that's fine.
It's great, yeah.
So But that money can be converted later to Roth when you retire and you're a lower tax bracket. So I'm okay with that. But my point is,
you have to pay taxes on it when you convert it?
You do, but what if you're in a zero tax bracket? I mean, we just converted $100,000 to a client, and he didn't pay any tax on the conversion.
Really?
Yeah, because he had a loss to offset it. He started another business.
Gotcha.
We did another one where he did cost segregation on his real estate, and he had this massive loss to help offset it.
Thanks for watching. You want to learn more? Check out these recommended videos on screen.